Hello, everyone, and welcome to the LockingYourSuccess.com Trading Performance Podcast with Master Trading Performance Coach John Locke, where it's all about real traders, real problems, and real coaching. This is episode number 41, and today I'd like to talk to you about a subject that comes up very often in our Go membership. In fact, we had a question on this for one of our Go Ask a Trader meetings, and that question was, how large of a trade size should I use with my retirement account relative to the account size? As you'll see through the answering this question, there are many considerations that you should consider when you're trading an option strategy in your retirement accounts. So listen up and enjoy the presentation. Building on your video, lesson 21 on money management, and this has to do with a FIT program, can you extend on this and talk about the pros and cons of trading a retirement account, in this case a Roth IRA? How do your general guidelines compare with retirement accounts? For example, what general percentage of that would be good to trade versus continue to leave in a mutual fund if the percentage is not possible to give, and what considerations should be made? So first of all, I want to just discuss with everybody something about account size in general. Account size means nothing. What I mean by that is that you should be trading based on your net worth size and your trading objectives and what your risk tolerance numbers are. So I'm going to give a couple of examples. All right. So for most people, if you go in the FIT program, we're generally saying, this type of options trading should be reserved for about 20% of your net worth. Okay. When that comes down to an account, though, it doesn't mean anything about how large you're going to trade these option strategies in a particular account, because you could have somebody with a $3 million net worth with a $100,000 account. I mean, I trade, if I had this type of options and I was skilled in it, I trade the whole thing with that, because realistically, if I ended up blowing the whole account for whatever reason, I did something completely foolish, as long as I'm not on portfolio margining and end up losing more than the account. But if I blow the whole account, it's only 3% of my net worth. It's not really that big a deal to me. I mean, it's not going to affect me one way or the other, right? On the other hand, I might be somebody who has a negative net worth. Maybe I'm overfinanced in some real estate or something like that, and I only have $100,000 cash, and I have a negative net worth, and at that point, I really shouldn't be trading at all. I would suggest to stay out of the market for most people. So that would be the general sense when we talk about using, say, 20% of your net worth in order to trade this. The account size itself really has no relevance. All right. The other thing I'd like to point out too is that other people have different goals. Like when I started trading, I literally had a $10,000 net worth, and I literally had like $10,000 in cash. I mean, maybe my net worth was a little higher than that, but that's all I had. And I'm the type of person who's willing to put everything on the line in order to try and make money. I mean, I did that when I opened my automobile business, when I opened up my BMW dealership. We financed everything I had, took all the cash that I had, we put it in that business. And, if that didn't make money on day one, it was going to be problematic. And luckily we did make money on day one. We were able to, get everything going and get that business off the ground right away. And I've also done that with other things. I mean, I've bought real estate and taken every bit of cash that I own and throw it into real estate, which is very risky, right? It's risky. I mean, you're risking everything that you have. And if you're not the type of person who's willing to do that, but if that's the type of person you are, then maybe you will put 100% of your net worth into an account. Maybe you'll even go negative net worth. But my main objective here is to make sure that you understand you're doing that. Make sure you understand what your risks are related with that. If you're like most people or a lot of traders, I can't say most, but like a lot of traders who come in here, we're in our 40s, 50s, 60s, maybe 70s, and maybe we don't want to start over again, in which case we want to limit our exposure to the marketplace in this type of options trading, which is where that 20% number comes from. It's more geared towards that type of a person than this type of person. Now, the third element is when we start bringing in retirement accounts. The thing you have to consider about retirement accounts are two things. Number one is taxes. Okay, you lose money in a retirement account, or gain money in a retirement account for that matter, you have tax considerations, right? You can't write off losses in your retirement account. Maybe you can talk to your tax accountant, but as far as my account is concerned, we can't do that. So I want to keep that in mind. The other thing, or even the bigger element of that, is the rate at which I can fund it, right? Dan's talking about a Roth IRA. If I have a Roth IRA, I can only put what, $6,500 now, $7,500 a year in. If I take that account and I blow, I don't know, $50,000 or whatever in some sort of a trading problem, it's going to take me a long time to be able to refund that account to the point where I can actually trade with it again. Okay, so that's the other thing I need to keep in mind. And I want to run those numbers out in my head and make sure I'm okay with those numbers. I mean, whatever you do is up to you. I'm not the type of person who's going to have a ton of money in retirement anyway. I mean, we have a lot of cash, we have a lot of real estate, we have businesses, right? We have a big trading account, or several big trading accounts, but I tend to keep my money out of retirement because I want the flexibility to do with that money what I will, so to speak. So I'm not so crazy about the tax environment. I know that I'm the type of person who's going to have that money available to me when I want to retire. The government doesn't control it. I have control of that money. So, we do have substantial retirement accounts, but as far as compared to what our net worth is, our retirement accounts are very, very small, actually. So, and again, that's just my personal thing, and a lot of other people might disagree with that, but that's what I do. So if you want to know, that's what I do. So those are the pros. That's what you need to consider primarily in your retirement account, and how big your trading options is your total net worth and the rate at which you can refund that account should the market come down, right? Because if you're talking about a Roth account and you don't have any earned income, you can't put any money in a Roth account, right? So you want to make sure that then if you want to have a Roth account, then you want to make sure that you take those into considerations. And there's limits on other accounts too. They're just much higher, but it still could be an issue depending on what you're doing. And of course, there are tax things that you might want to consider.
And that is what I have for you today. If you like what you see, I encourage you to come on over to lockeinyoursuccess.com. That's LOCKE in yoursuccess.com, and check out our Trading Performance membership as well as our Pro membership, where you too can learn the vital information you need to excel in your trading and in your life. If you have any questions or comments or anything else you'd like to see in the next Trading Performance podcast, please make sure you comment in the videos below, and I'll make sure that I answer those questions for you. Thank you for joining me, and I look forward to seeing you on the next Trading Performance podcast.